Hello class, and today what we're going to do is chapter 9, which is inventory costing and capacity analysis, but in reality all we're going to be doing is talking about inventory costing today. Now, there's two types of costing that we are going to be dealing with in this chapter. The first one is variable cost. And what that is, variable costing is a method of inventory costing in which all variable manufacturing costs, both indirect and direct, are included in the inventoriable cost, also known as direct costing. So, one thing just to remember, anything that's variable cost, which is direct labor, direct materials, variable overhead costing, or variable over manufacturing overhead costing cost, and variable selling cost is another one. Anything that is variable will go up in the top line. Under absorption costing, it's the method of inventory costing in which all variable and fixed manufacturing costs are included as inventoriable costs. You can say the inventory absorbs all manufacturing costs. So the difference is variable costing, anything that's variable goes up on top. Anything absorption costing, all the manufacturing cost goes up on top. So that includes direct labor, direct materials, overhead, both fixed and variable. So just keep that in mind. Those are the two differences between those two. Now, the differences in income. Operating income will differ between absorption and variable costing. It just how it is and how you figure it out. It's always going to be different. The amount of difference represents the amount of fixed manufacturing costs capitalized as inventory under absorption costing and expense as a period cost under variable costing. So it all focuses on the fixed manufacturing cost. If inventory levels change, operating income will differ between the two methods because of the difference in accounting for fixed manufacturing costs. So just keep in mind the difference really is guided towards because of the fixed manufacturing costs. Now let's take a look at the two different type of income statements that we get from variable costing and absorption costing. Let's look at the variable costing first. We have revenues, and basically they're going to be selling 6,000 units here at $1,000 per unit. So the revenues is $6 million. Both cases, we're not going to have any beginning inventory. And so the variable manufacturing costs are $200 per unit. And we're going to be producing 8,000 units for $1.6 million. So the cost of goods available for sale is $1.6 million. The ending inventory, we're going to take the 200 times the 2,000, back that out of 400,000. So the variable cost of goods sold is $1.2 million. Goes on to tell us that the variable marketing cost is $185 per unit. And since we sold 6,000 units, that's the number that we use. And so that means that the variable marketing cost is $1,110,000. Now, you notice here on the variable costing, we're going to be using the contribution margin. Again, what's the contribution margin? That's revenues minus variable expenses. So we take the 6 million minus the 1.2 million minus the 1,110,000. We get 3,000 or 3,900. I'm sorry, 3,690,000. Then we put in all our fixed costs. We have fixed manufacturing cost of 1,080,000. We have fixed marketing cost of 1,380,000. And so we take the 3,690 minus the 1,080,000 and the 1,380,000. So my operating income here is 1,230,000. Okay. Now, the manufacturing cost expense in panel A here, we have the variable cost of 1 million, the fixed manufacturing cost of 108 or 1,800,000, or I'm sorry, 1,080,000. So a total of 2,280,000. Now let's see the difference with the absorption costing. With absorption costing, I still have the same revenues at $6 million. And of course, my beginning inventory is zero. Now, in absorption costing, we're going to have the variable manufacturing costs and the allocated fixed manufacturing costs. So what I'm going to be doing is taking the $200 per unit, multiply that by 8,000 units, I get $1.6 million. The allocated fixed manufacturing costs, I get $135 times the $8,000 or 8,000 units, and that gives me 1.8 or 1,800,000. I'm sorry, 1,080,000. Which, if you notice, it's the same over here, over on the same thing, so that we still have the same amount of fixed manufacturing costs. The cost of goods available for sale, you take the 1.6 million and the 1,080,000, add those together, I get 2,680,000. Then I back out the inventory, the ending inventory costs. And how did I get that $335? I take the variable cost per unit and the fixed cost per unit. Now, how did I come up with that one? Anybody want to take a guess on that? Well, I produced how many units? We produced 8,000 units. So to get the fixed manufacturing cost per unit, I took the $1,080,000, divided it by 8,000 units, and that's how I got the $135. I add that to the variable cost per unit of 200, I get the 335. Multiply that by the 2,000 that's left over because we only sold 600. That's $670,000. So the cost of goods sold is the 2.68 million minus the 670,000, and I get $2,010,000. Now on the absorption costing, you're going to be doing gross margin. So the gross margin, of course, is going to be your revenues minus your cost of goods sold, and that is 3,990,000. My variable cost per unit, marketing cost per unit, is $185 per unit. And so here we only use the units sold. So we have $185 times 6,000 units. That's $1.11 million, or 1,110,000. And then we have our fixed marketing costs of $1,380,000. We back that out from the gross margin, so my operating income is 1.5 million. And again, the manufacturing cost expense in panel B was just the cost of goods sold of $2,010,000. Now, this chart is actually in your book. If you look on page 334 in your book, you'll get these, the comparable of the multi-year charts. Now, the top part is just what we just went through. And so then we have to start with the bottom part. Now, the first two columns is just 2004, which is what we just went through. And then the second two columns is going to be this next year, 2015. Now, in 2015, we sold 65 units, or 6,500 units. And so we take the 6,500 times 1,000, because they didn't change their revenue per unit. And so I get $6.5 million on variable costing, which is the top portion of this. Now, my beginning inventory, of course, is the ending inventory from the year before, which is $400,000. And then my variable costing per unit did not change this year. So I'm going to take the $200, and I only produced 5,000 units this year. And so I'm going to take the 2,000 times the 5,000, 200 times 5,000 units, I get $1 million. add that to the 400, the beginning inventory. I have a total cost available for sale of $1.4 million. My deduct any inventory. According to the information here, we have 500 units left, so I'm going to multiply that by the 200. I get 100,000. So my variable cost of goods sold is $1.3 million. Now, again, we have 6,500 units that we produced. We're going to multiply that by the $185,000 per unit for variable marketing costs, and I get $1.3 million. I'm sorry, the 1,202,500. So my contribution margin, I take the 6.5 million minus the 1.3 million minus the 1.2025 million, and I get $3,997,500. I get my fixed manufacturing costs. They're saying stayed exactly the same from the year before. So I have 1,080,000 and 1,380,000 for the fixed marketing costs. And so taking the 3 million minus the 1,080,000 minus the 1,380,000, I get $1,537,500. So that's the difference between variable costing. Now let's look at absorption costing. Now we have, of course, the same revenues, but our beginning inventory is different. The ending inventory from 2014 was $670,000, so that's my beginning. My variable manufacturing cost, again, is $200. I had 5,000 units produced, so I'm going to take the 5,000 times the 200. I get $1 million. Allocated fixed manufacturing cost, again, we produced 500, so I'm going to multiply that by we produced 5,000. Multiply that by 135, and I get 675,000. Add those three numbers again together. I get available for sale for 2,345,000. Subtract out the ending inventory, so I have 500 units times the 335. That's 167,500. So my adjustment for the production variance. Now, how did I come up with that? It equals the budgeted fixed manufacturing cost minus the fixed manufacturing overhead allocated using budgeted cost per unit output. So what we did was take the 1,080,000 minus the allocated fixed manufacturing cost times 5,000, and I get a unfavorable outcome of 405,000 units or dollars. So my cost of goods sold is 2,582,500. My gross margin, if I take that away from the 6.5 million, my gross margin becomes 3,917,500. Variable marketing costs, I take the 185 times the 6,500 units. I get 1,202,500. And my fixed cost, of course, stays the same. So my operating income goes to $1,335,000. So let's look at the difference. Let's compare them. This is actually located on page 337 in your book. So in the first question that they ask, are fixed manufacturing costs inventoried? And under variable costs, fixed manufacturing is not inventory, because remember, variable costing is only including the variable cost of the production, has no fixed costs involved. But in absorption costing, remember, all manufacturing costs are involved. That's including both fixed and variable. Is there a production volume variance? In variable costing, we don't have that, but in absorption costing, yes, we do. Are classifications between variable and fixed costs routinely made? Yes, in variable costing, but infrequently in absorption costing. Absorption costing can be easily modified to obtain subclassification for variable and fixed cost if desired. How does the change in unit inventory affect operating income? And if production equals sales, then in variable and in absorption, they are equal. Um, if production is greater than sales, then the level of inventory is lower, or it has a lower effect on operating income, and it has a higher effect under absorption costing. If production is less than sales, it has a higher effect on variable costing and a lower effect on absorption costing. What are the effects on cost volume profit relationship for a given level of fixed cost and a given contribution margin? Under variable costing, it's driven by the unit level of sales. Under absorption costing, it's driven by the unit level of sales, the unit level of production, and chosen denominator level. Now, absorption costing is required inventory method for external financial reporting in most countries. It is also preferred. And why is it preferred? Well, it is the most cost effective and less confusing. Basically, absorption, you are putting all manufacturing costs involved. It can help prevent managers from taking actions to make their performance measures look good, but to hurt the income they report to shareholders. So basically, what's happening there is if we're under variable costing, they could play with the numbers, push up production to get those numbers higher. It measures the cost of all manufacturing resources, both variable and fixed, necessary to produce inventory. So, in other words, it's pretty much more accurate in regards to the cost of the product. So, absorption costing and performance measurement. One unfavorable attributes of absorption costing is that it enables managers to increase margins and therefore operating income by producing more ending inventory. So basically, it will drive up the costs, which would increase. They could make it look better for them. Producing for inventory can be justified when rapid growth is forecasted, but should not be undertaken simply to boost profits. So basically, if we know that we're going to be selling more in the future, then we can boost the production. But if that's still not for sure, it's better to be conservative. To reduce the undesirable buildup of inventory, companies can use variable costing for internal reporting purposes, including performance measurements. Now, some proposals for revising performance evaluation. To reduce the undesirable effects of absorption costing, a couple things that management can do is focus on careful budgeting and inventory planning. So, the better they are at making sure that they are hitting their budget and only producing what they need is beneficial. Incorporate an internal carrying charge for inventory. So basically, this would happen if a manager has increased their inventory, they could add a charge to their books so that it would offset that increase in inventory. Change the period used to evaluate the performance, so make it longer. Include non-financial as well as financial variables in the measure of evaluate performance. Compare ratios of beginning or ending to beginning inventory to ratios of units produced sold. All right. So that pretty well sums up absorption costing. The examples that we're going to be doing, we will be showing those in a separate video. And I will get that up here shortly. If you have any questions, please do not hesitate to ask. Goodbye.